Warren Buffett talks about diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. You know, the big risk out there is not necessarily lack of diversification. In fact, the more I have diversified in my portfolio, I seem to get more problems than I would like. I'm of the opinion that the human mind can only absorb so much information. So you need to be a know-something investor about what you're investing in. And so if you have a portfolio of, let's say, 30, 40, or 50 stocks, or you're in a mutual fund, and the thing that gets me about mutual funds, people will buy a mutual fund and not even know what's inside of it. So this is an interesting quote. There are two ways to be fooled. One is to believe what isn't true. The other is to refuse to believe what is true. And so what is true is that leverage can be a really bad investment idea. You see, the beauty of the stock market is you've got daily liquidity in the securities that you invest in. And in my personal opinion, you should never invest in something that does not give you daily liquidity or a daily price, because you know price is pretty much everything. But recently, a leveraged fund dropped by $35 billion in just a matter of days. And also at the same time, we're seeing a lot of these leveraged ETFs coming to market. Look at this. They basically have tripled in volume, trading volume, since 24 to 26. So what's happening here is that everybody is doing what is easy, which is just to go into a fund and not find and research the individual securities within the fund, because I think you need to do that. But leverage is just a terrible idea. Back in the 70s and 80s, I experimented around with margin investing, and I didn't do well. It was not a good idea. In fact, leverage kills. My good old friend, who I never knew, but was a great investor, was Jesse Livermore. And it's a trader made $100 million in 29. By 34, he had nothing left. And in 1940, he committed suicide. And that was because he had heavy leverage and it went against him. So leverage is just not worth it. You know, when you think about these funds that are triply weighted or double weighted with leverage, look, the stock market is difficult enough. Why do you want to make it twice or three times as difficult? It just doesn't make any sense. The Battle for Investment Survival, Gerald Loeb. This is absolutely the Bible for investing, because if you think about the title, what Loeb says in the book is that the first thing you have to learn is how to survive. Because if you don't know how to survive, that when that roaring bull market finally comes and you haven't protected your capital, you won't be able to participate. So when it comes to things like diversification, he says in the book, obviously our ideas will sound wrong to most people. Any investment policy followed by all naturally defeats itself. Thus, the first step for the individual really trying to secure or preserve capital is to detach himself from the crowd. In other words, quit watching CNBC. He then goes on to say, he says, one must confine one's first efforts at cooking to boiling eggs. One does not begin with baked Alaska. So that is a really key point, because I must say, my first 20 years as a professional investor, I made so many mistakes. And it wasn't until I got into my 40s, 50s, and 60s that I started to finally just put it together. But in those early years where you're learning how to boil eggs, don't try to jump in there and do baked Alaska. So I think it's a great point made by Gerald Loeb. Great book. Everybody should read it. Carl Icahn, he was known as a corporate raider, and his primary job or career was that he would identify a good business, and then he would look at the numbers and say, hey, this is a great business. Why isn't it doing better? And it was usually because management was just dropping the ball. So as a corporate raider, he would go in, take the company over. I thought it was also interesting that he said that when he would interview a CEO for his companies, if they had an extremely low golf handicap, he wouldn't hire them. Because like this, it says, successful people know they need to get many things done and done effectively. Therefore, they concentrate their time and energy on doing one thing at a time and on doing first things first. Basically, he's saying that a CEO that is spending too much time on the golf course is not focusing on what he needs to be focusing on. So it's like a professional investor such as myself. I spend my entire day, 24/7 basically, evaluating my portfolio and evaluating the stock market. So it's just one thing that I'm good at and one thing that I do. So patience is not simply the ability to wait. It's how we behave while we're waiting. So my point there would be, when we get into these lackluster markets, which we're pretty much in right now, and there's really not a lot to do, this is a real good time to be patient, number one. And number two, you should go read some books and do some studying right now and not be too concerned about what's going on. Because as you can see here, for the last 1, 2, 3, 4, 5, 6, 7 trading days, the market's basically gone nowhere. So, however, and I'm using the QQQs to represent the NASDAQ here, volume is somewhat drying up. I guess we're in the summer doldrums here. Here's the correction we just went through. We've gotten it back the 21-day, above the 21-day. Now, what we're looking for is a follow-through day, which we have not gotten yet. So, we're watching. We're definitely watching. So, if we look at the S&P represented by the SPY, because I can get current volume on that, you can see volume's pretty lackluster. We're just basically moving sideways. Now, we are in an attempted rally here, starting here. So we've gone 1, 2, 3, 4, 5, 6, 7, 8, 9 days of a rally. But we're not getting that follow-through day. We're not getting that breakout. So it's kind of a good time to do some reading right now. So let's talk about interest rates, because a lot is going on there with the new Fed chairman. Mortgage rates are pretty much stuck in a trading range, but they're relatively high. I mean, we're at roughly 6.7%. So if you look at just interest rates and look at our indicator, which is the power index, we're at 125 days, up 17%. So there's no doubt about it that the 5-year Treasury bond is in an uptrend. Interest rates are definitely in an uptrend. So if you just look at the 2-year uptrend, you look at the 5-year uptrend, and then you look at the 30-year, as well, an uptrend. So what I'm saying is that the interest rate picture is not positive. So hopefully we can get some stabilization there. However, the good news is on the unemployment rate, we're seeing, a very strong economy here. I mean, we're seeing an improvement. We're down to 4.1% unemployment, where we were up to about 4.3, and we got up as high as 4.5. Now, there's an indicator used by a particular analyst that I follow that measures the unemployment rate relative to a 36-month moving average. Now, this is all back-tested. Now, this is COVID. This would be COVID, so you really kind of have to take that out of the picture. But his thinking is that when the unemployment rate is above this moving average, that indicates a possible recession. Well, actually, we're seeing improvement here, and this is the first time since I've been following this indicator that it is below that 36-month moving average. So hopefully unemployment continues to be strong. The aggression index, where we're comparing the NASDAQ to the consumer staples, again, just like the indexes, just moving sideways, not a lot really to say that's going on. Now, sentiment. I'm adopting here a new indicator. Well, I've known about it for a long time, but it's called a put-call ratio. And when people are buying puts, they're negative, and when people are buying calls, they're positive. So when the puts outnumber the calls, the line goes up. So you can see here that we're pretty much challenging the highs of the year with the put-call ratio. Pessimism is pretty high, which it's hard for people to understand, but when everybody's optimistic and everything's go, 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 that's where the great risk is. So when you don't have a lot of optimism, it's telling you that this bull market is probably going to be okay. Now here's the AAII bull-bear ratio, which is another way to measure sentiment, and it's still a negative 1.0. So we're not seeing a lot of euphoria and so forth, which in my book is a positive. So the main trends are up. The S&P 500 continues to be in a main trend of positive main trend. The NASDAQ is in a positive trend. We just had a major correction in here and so forth. So things are starting to look better, looking stable. Call me if you have any questions. Thank you very much.